And Ruth, with that introduction, it being 9:30, good morning to all on the call and welcome to FirstWave's FY23 Q4 update. For those of you who haven't been on one of these updates before, my name's John Grant and I'm Non-Executive Chair of FirstWave. I'm joined again today by CEO, Managing Director and Major Shareholder, Danny Ma, and Chief Financial Officer and Company Secretary, Ian Bartram. You can see the agenda for today on the slide. I'll make a few introductory comments before handing over to Danny to take you through the highlights for the quarter. Ian will then deal with the financial performance before handing back to Danny for a broader update. We'll then open your call for questions. You'll recall, I hope, the three key elements of the strategy Danny put to the board in July last year: sales-led culture, grow faster, and be capital efficient. He and the board have applied this lens increasingly across each area of the business. We know the limitations of our financial and human resources, and we also know that it's vital they be applied to greatest advantage. That means we need to make considered and data-driven choices. You'll see some of these starting to play out in what Danny and Ian have to say to you today. Also, it's fair, I think, to describe our fourth quarter as solid, if not spectacular. The significant US opportunity Danny spoke about some time ago remains exactly that, significant opportunity, the timing of which is not entirely in our control, clearly. But revenue growth quarter on quarter was solid, cash management is excellent, and operationally the business is as close to optimised as the capital we're prepared to apply can get it to be. Danny and Ian will elaborate further, so with that, let me hand over to Danny. Over to you, Danny.
Okay, thanks, John. Hi, everyone, wherever you are in the world, and welcome to the update. I can just hear my croaky voice. I've just returned from a trip to Mexico, visiting some key clients, spending some time with our team there. It's taken me 37 hours to get back, which was a bit of a nightmare. So I apologise if my voice cracks up a little bit. I guess I should comment that it was a fantastic trip. We've got some really good opportunities there in Mexico, and I enjoyed spending some time with those clients and the team. So on to the update. I'll just run through some quick highlights before Ian runs through the financial results, which is the main focus of today's session. It's been a busy quarter for us with further reformations to the business, some of which you'll hear about in this update. But in summary, our revenue is up 9.2% quarter on quarter, which we regard as a good result. A lot of this is still one-off revenue, and Ian will detail that a bit further. Our gross profit was also very pleasingly up 13.3% quarter on quarter. Our cash usage was approximately $480,000 per month, which exceeds our cash objectives. I will flag that our trade debtors went up significantly due to a pleasing level of sales at the back end of the quarter. So when listening to Ian's update, have a think about our working capital, which is better than our cash result due to the increase in trade debtors as well. We've been focusing on biasing our strategic investments towards the network management part of the business, and we'll talk a little more about that in the update. And somewhat in line with that, we've also been continuing our CyberCision platform consolidation, which is making us more efficient and making that area of the business more profitable. So to me, that's the main highlights, and I'll hand over to Ian for now to run through the financials in more detail, and then I'll be back to speak again before we take some questions.
Thanks, Danny. Picking up on these points and expanding on some key financial results in the quarter. The revenue recognised grew by 9.2% to 3.1 million. This revenue includes 350,000 in non-recurring or one-off revenue, which continued the pattern of one-off revenues being important in the total makeup of FirstWave's revenue profile. There was some customer churn towards the end of the quarter that resulted in lower recurring revenue in June than prior months. And given the ARR is calculated from multiplying the recurring revenue in the last month of the quarter by 12, ARR was down 5% to 9.33 million. However, there was a customer win at the end of June and an uplift to a long-term client's contract that was also signed in June, where both the new and the uplifted revenues started on the 1st of July, and the ARR increase from these two deals combined will lift the ARR in July to higher than the Q3 level. In parallel to this quarterly update, we're working through year-end adjustments, including a review of the various accruals and provisions on the balance sheet. We anticipate a reduction in provisions for third-party costs for products that were announced as end of life in the year. These reductions will have a positive impact on gross profit, but they do not specifically relate to the quarter and are yet to be finalised. And so we have reported gross profit on a pro forma basis to ensure a like-for-like comparison of the business's quarter-on-quarter performance. The pro forma gross profit grew by 13.3%, with the mix of revenues having shifted towards the higher margin products, and hence the overall margin increasing by nearly 3 percentage points to 79%. The financial statements will show further improvement in gross profit when the adjustments I mentioned earlier are finalised, and these will be released to the market towards the end of August. So in summary, ARR is down. However, this reduction has already been recovered. Revenue is up and gross profit margin has improved. So moving on to the cash position. The business finished the quarter with 5.61 million in cash and cash equivalents, having used 1.45 million in the quarter. This included trade debtors having grown by 860,000. And trade creditors also growing, but only by 220,000. This means there is an additional 640,000 of working capital at the end of the quarter than there was at the start, which is currently held in the net balance of debtors and creditors. Another way of looking at this is if trade debtors and creditors had remained consistent across the quarter, the cash balance at the 30th of June would have been 6.25 million, and cash usage for the quarter would be down to 905,000. To get a true picture of the current health of the business, cash usage over a quarter needs to be adjusted for the timing of various items, such as the R&D tax offset grant. The R&D grant is received annually, and the most recent grant, being approximately 1.2 million, that we should attribute 100,000 of income to each month to get a normalised view. The annual insurance renewal process has been shifted from the 30th of June to the 31st of March, and hence there is a significant annual insurance cost of over $400,000 that has been paid in Q4, when only a quarter of that payment should be attributed to normalised cash usage in the quarter. As communicated in previous updates, to reduce any subjectivity around the inclusion of one-off revenues, we adopt a fixed methodology for calculating the amount of one-off revenue to be included in the normalised figure. The methodology is to take the monthly average of the actual one-off revenues over the last 12 months, which was 110,000 per month at the end of Q4. These adjustments and assumptions result in a normalised monthly cash usage figure for Q4 of 470,000, which is 90,000 per month improvement over the estimate at the end of the previous quarter. And looking across the full financial year for FY23, we actually used an average of 400,000 per month, which is well under half of the $1 million per month cash usage that was being reported 12 to 18 months ago. I will now hand back to Danny to provide some further commentary on the business's performance.
Thanks, Ian. Some good colour there, I think. Each of these updates, I'd like to recap on the strategic priorities of the company. They remain the same as they've been for around 18 months now, and that is to pursue a sales-led culture, to grow our revenues faster, and to be capital efficient. We continue to drive the company activity at those objectives, and we continue to progress all of those objectives. Each one of these areas has had significant progress and also has further progress to come. In relation to growing our revenues faster, I'm pleased to let you know that we did quite a few deals at the end of last quarter, and there are two larger ones which I wish to highlight. Firstly, we renewed a significant Australian government client through a partner. That is a Cybercision deal, and that renewal came with some nice level of uplift, which was great. We also signed a new US government client through a partner in the US, and that was a nice win for us, and they'll be using our network management products. We continue to be negotiating with a significant US organization around the network management products. I know we've mentioned this before. These negotiations have been going slower than what we would have liked, but it's not really in our control. They have had some procedural changes in the way they engage suppliers, and that's what slowed us up a bit. But we're pleased that this has now progressed into procurement. It will take some time to pop out, but we remain comfortable that it's coming. While of course I note that a deal isn't a deal until it's done. And for me, even I like to see the money in the bank and the products delivered, and be as deep into it as we can. But we are still confident in that. We're focusing our sales efforts around service providers and large organizations in our strongest markets, which are the US, Latin America, and Australia. And we're focused on our highest margin products, in particular the network management products. And also thought I'd let you know that we've hired another new account manager. This time, the addition to the team is Hector in Mexico. So we continue to invest in the growth in our sales and marketing, and Hector's going to do very well for us, I'm sure. In relation to being capital efficient, we continue to prioritize cash management while making strategic investments which are biased towards the strong growth potential in our network management products. We feel we're doing a good job of managing our cash. The CyberCision platform consolidation process continues. We saw the decommissioning of 2 platforms in this quarter and a successful migration of all the clients to a single platform in Sydney. So that's creating efficiencies for us, and that's going well. Pleasingly, we've also renegotiated some third-party supply agreements, and that will generate some further efficiencies and improving margins for the company moving forward. So some really good things happening with our use of capital. In closing, we have a pipeline of new opportunities, and that pipeline remains healthy. There are some protracted purchasing cycles, particularly with the large US client, which I've highlighted. But I do want to make the point that the business has the flexibility and levers to deal with a range of eventualities, and also that in particular, we don't need the large US client to execute our plans, which in a way what makes it even exciting once we close them. Our full-year results will be released at the end of August, but of course we have now delivered updates for each of the quarters, so we can all get a fairly good visibility into what the year looks like, and that it has been a highly transformational year for the company, and we're looking at a very different company now to what we were 12 months ago. So overall, I just want to thank you all for your patience. I'm an excited investor. I know I get to see a bit more as CEO than you all do, but I hope this update has helped share some insights, and I expect to have some nice announcements coming for us all this quarter. And with that, I'll hand over to John to facilitate some questions, so you can let us all know anything else you'd like to hear about.
Thanks, Danny, and thanks also to Ian. Let's now move to your questions. The way you can get to us is you can type them in on either the chat or the Q&A function in Zoom, or raise your hand to speak. Over to you. There is one question, Danny, or there's 3 questions now, which is excellent. Thank you. So from the top, John Blangiardo, have I got that right, John? John says, how does and will AI affect the company, and what are you doing to be part of this new wave of AI? Danny.
Okay, good question, which I'm glad you asked, as they used to say on the Curiosity Show, for anyone that's old enough for that. We have AI within our network management products, and we also have some algorithms leveraged by our third parties within the CyberCision portfolio. We're looking at how we bring those forward in our marketing. With the specific area of AI that we mostly deal with is in machine learning, but we do have elements of that, and we are interested in developing those things further. There's a particular product we have called OP Trend, which not a lot of development effort's gone into. We're looking to ramp that up further. But yeah, so we do have some AI, and we're looking at bringing that more forward in our marketing is the summary. Yeah.
I think if I can add to that, what we have done before for all of our investors and shareholders, or interested parties and shareholders, we've done a technology roadmap update. I'll have a talk to Danny after this call, but I think it's appropriate to do that. I think there's products in our portfolio that we haven't yet profiled, and therefore you don't know where they sit, and also you don't know what the advantage of having them is. And that requires us to talk in detail about the product structure and the product strategy and roadmap. And I think we'll try and schedule a session to do that, maybe even in line with the full year results. Anyway, leave that one with me and Danny. If I can just add another comment on AI. Unfortunately, I've been around too long, and I've seen too many next great things. And AI is going to be a really great thing, and it's going to really revolutionize the way the world works. And in order to do that, it has to revolutionize the way software works. So Danny's comment about already dealing with AI and certainly having it on our roadmap and getting to the more, if you like, the more commercial aspects of AI, bringing in AIs that's already available and integrating our product. That's sort of how that all fits together. But this will take time to change. And that's what happens with these sorts of things. And any of you who are familiar with the Gartner hype cycle will understand what I mean by that over time. So, John, if you haven't had a look at the hype cycle, go and have a look at it. AI is in the first part of the curve. It's in the new adopter stage. That's where a lot of money is going into it, and the new adopters are getting it and waving a big flag, which is the job particularly of this industry. It then needs to move through that curve. So we see it absolutely moving through that curve. We also see the timeline for these sorts of innovations is changing dramatically from what it might have been. So we're in there and we're being responsive as we should be to the need for the opportunity with AI. Moving on to the second one, Nick Harris. John, I hope that answered your question. Come back if you need more. Nick, hi team, thanks for the call. Can you please provide a bit more colour on the increase in salespeople over the last 6 months, e.g. how many people now versus 6 or 12 months ago? All going to plan, should we expect they can help lift sales in, say, another 6 months, or how can we quantify the expected return?
So to just pick up on the numbers for Nick there, we've increased the number of people in sales from 7 to 11. There are some people that are part-time, and so it's full-time equivalent in there, but an additional 4 resources, which is, between 30 and 40% increase, which is quite a big increase. One of those was a person returning from maternity leave. The others were new hires, but one of them had previously worked for the business and is a known quantity. So that's the sort of level of increase. There also has been some shifting around in terms of priorities. And as Danny mentioned, some of this sort of change of focus, that's not just across products. Some of that is moving people who might have been in a development capacity previously into a pre-sales capacity or even a sales capacity. So there's been some change of focus as well as some change of total number of resources.
Yep, and there's an extra couple in marketing as well. I think that thinking about that 40% number as an increase is a pretty good illustration of how to think about it. It's pretty significant.
I think to add to that though, what happens when you recruit people is they need to get their feet on the ground, and it takes time. So just dealing in with the second part of Nick's question, which says all going to plan, should we expect they can help lift sales in, say, another 6 months? Danny?
Yes. So, there's a couple of aspects to it. I mean, good salespeople can do a bit of their own hunting, whether it's from their own book or they just find ways to come across opportunity. And there's also the marketing aspect, which is heavily focused on providing them leads. So we need both those things working together. And it's a big focus for us to get the metrics around that, like how long does it take us a rep to come up to speed? How much does it cost to get them leads so that they're, fully utilized? So we're continually looking at the financials around that, and they're improving for us. So we're getting better at it, and the better and better we get at it, potentially the more we can put into it if we know we're going to get the money back within, 6 to 12 months. But you're probably looking at, in our case, you are looking at that period for a rep to ramp up. 6 to 12 months it's more than 6 months.
I think it's also just on that, it's a bit the go-to-market, Nick, also. What Danny's referring to is an enterprise sales process led by a sales executive, and that's the modus operandi that we've dealt with forever. whether it be in the pre-op tech, whether it be in the Cybercision days where we needed to talk to the big telcos then needed to talk to their downstream distributors, etc. Even in that situation, we're still dealing in an enterprise sales environment and trying to sell to that telco. And it's the same with the network management software. So we are an enterprise sales organisation. That's the way we engage with our customers, and that's the way we drive revenue, and that takes time. So Danny's answer to your question about, say, another 6 months, it was yes. That's certainly what the board's wish and hope would be. And in 6 months' time, Nick will know. And in terms of quantifying the expected return, how would you answer that part, Danny?
Well, I tried to touch on it. Like it does take more than 6 months to get the return from account managers, but you've got a couple with marketing spend as well, and we're constantly working on those metrics. And those metrics are getting better and better for us. We on the network management side, you get paid 12 months upfront typically. So that's they buy a subscription and they pay 12 months in advance. So it can be self-funding within 6 to 12 months and get your returns in under 12 months.
The old metric around return from enterprise sales specialists expenditure on, so remuneration, was sort of in the 3 to 5 times range. That's a metric that's been in the industry forever. So that's the sort of thing that you need to get in order to sustain an organisation's growth and its cost structure. So I don't. Sorry, Dan.
Yeah, so we will get that. However, the clients, in subscription software business, if we're selling perpetual licenses up front, you'd get a lot more money quicker, whereas a subscription, you get it over a number of years. So if a customer stays, for example, 8 years, the first year tends to be somewhere around our costs, and then we tend to be making our money in the next 7 years. So giving you that return in the range that John's talking about after you take out some support costs.
Okay, thanks again, Nick. Come back to us if you need more. And then we've got an anonymous attendee. What is the timing or roadmap to being cash flow positive, and how do you think about this versus investing in growth?
The timing is the end of this financial year is our target. So we'll enter next financial year in a cash flow neutral or positive manner. If we do large deals, of which there are a few in the pipeline, we've noted the US one. That can change our cash position dramatically and might cause us to reassess, because we might want to be investing further if we're getting the money from customers, not the market. But putting these kind of large deals to the side, including the US one that we mentioned, the target is to exit this financial year in a cash flow neutral manner. In terms of investing in our growth, to hit those targets, our plans are to get the growth. That gives us so growth allows us to hit those targets. If we don't get the growth, we've got other levers to pull. And remember, this is growth outside those large deals like the US one. So we think we're sitting very well, actually.
Thank you. Again, come back if you need more. Kim, thank you very much for your question. Nice try. If you see how Danny answers this. What's the magnitude of the big US deal mentioned, Danny? You can't mention it, Danny.
I know. I was going to say I'll have to take. Could I say? I don't know how much colour.
No, the answer.
I have to look to our chairman here, Kim, to see what he's prepared to put out publicly.
Look, I think this has been tough for us, right? I mean, the way you build businesses is you chip away at it, and then all of a sudden something happens and you get a breakthrough, and then you lift to another level, and then you start chipping away again, and your cost structure needs to catch up, and all the organisation needs to operate differently, and then you keep going, and that's how you build a business over time. And the biggest contributing factor to that is getting the right customers over time. So when we talk about the significance of this, and when Danny first introduced it to you, it's very dangerous, right? For all the obvious reasons. But it's one of those dial-turning deals that takes the organisation to the next level. We're not in the position to either say who it is nor quantify it, Kim, as you'd understand it. And I thank you for your question. But what I can say is it's one of those deals that will turn the dial for this company, and that's really important. It's not vital, as Danny says, because you can just keep chipping away, right? We're going to get to cash flow positive. We're going to get cash flow positive. They're going to grow over time, but these things come along and these are the things that really lift you. So it's one of those. Danny's, and both I and Danny have said, because we've been here before, right? With Cyber, we had a very big opportunity in the US with a global telco that was effectively signed off. And then, of course, from up top came a change in strategy entirely and the whole thing disappeared. So, that sort of stuff happens. We don't think it's going to happen in this state, in this situation, because we're too advanced in the process, but you never know. But my point is that this is one of those dial turning deals, and there are others that we can identify in the pipeline. So, time will tell. Again, Kim, I don't know that I can offer you any more on that, but if you've got another question to ask or another aspect to try and get that answer, come back at us. Are there any more questions?
I'm itching to answer that, Kim, but it's what it is. Sorry.
Okay.
It's a good one.
Right, last crack. Any other questions? Nothing on the chat. Thank you. We've answered all the questions on the Q&A. Again, we're all very accessible. If you've got further questions, want to have any further conversations, give Danny or Ian a call. And if you need further to that, then give me a call. All right, everyone have a great day, and thank you very much for joining us on this call. Cheers.
Thanks, everyone.
Thank you.